Awesome. Well, it's a small group, so I think you guys can interrupt me at any time. This is like super fun when it's a small group. So I have a talk. My title is What Investors Want. If any of you wants to raise money, I think this is a useful talk. I will start with 5 minutes about myself and Pear, so you have a sense where I come from. This is my bio. I am from Barcelona, Spain, and I came to US in 1995. I'm got a PhD in electrical engineering, and I'm a chip designer by training. So I did a lot of chip design. After Stanford, I started a company called Barcelona Design. It was a big decision to not go to academia and instead start a company. And I have the rocket going up and down because that's what happened to the company. After that, I started 2 other companies, which were good exits. And finally, I started Pear 10 years ago, where we back seed and pre-seed companies. And, because we're all humans, I have a family, I have 3 kids. And actually, one of them is here in the first row. So, that's one of the reasons I'm here. She's really embarrassed right now, but that's my family. And I also like to run. I like hiking. This is me in Machu Picchu. We got there and there was nobody when we arrived. So I thought it was like a big sign. The trains were broken, so it was empty just for the people who were there. And I like to quilt, which is the closest art to math. So I actually like it. So anyways, that's a little bit about myself. And then a little bit about Pear. This is a picture of our offices, but we are focused at pre-seed and seed investing. What does that mean? We invest super, super early when there's basically nothing in the company. There's probably an idea or an early prototype. We invest really at 2 entry places, pre-seed and seed, and we'll write checks anywhere from $250,000 to $5 million as an entry point, and then we follow on in the next rounds. So it's a wide range of being early. Early means a lot of things, and I'll clarify that in the rest of the presentation. We've been very fortunate to have many unicorns already in our portfolio. We've had 3 IPOs, and we've invested in companies all across many sectors: consumers, B2B, fintech, bio, climate, etc. So I'm very fortunate that I can go from sector to sector all the time. And we invest really, really, really early. So I'm going to give you 4 examples. We actually 50% of the companies we back are founded by students. So people like you, that's my expertise. And I'll give you a few examples of folks that we invested in when they were students. This is one of them. They're called Affinity. It's a CRM. It's basically a giant database where people store their clients and it's sold to the financial industry. We invested in them where they were sophomores in college. There were 2 employees and of course, no revenue and no money raised. And, today they have 300 employees. They've raised over $120 million and they track over 500,000 companies, maybe more now, closer to 1 million, which is a big deal. So, it's interesting because they invited me to their 21st birthday party. It was a big achievement for them. Okay. This is another company we backed called Aurora, Sam and Chris. There were also 2 people and they had raised no money and they were interested in climate 10 years ago when it was really out of fashion. They stayed in our offices for about 2 years and ultimately they built Aurora. Aurora is a big company, 400 plus employees. They've raised $500 million and, they are designing, close to 1 million houses per week, which is crazy at the moment. This is Garden that Allison mentioned. We backed them when there were 3 people. Again, 0 raised. They are a company providing liquid biopsy. Garden went public currently at a $3 billion valuation. It has over 2,000 employees. And these guys were also in the lab and grad students, I guess, if you want to do biotech. And finally, DoorDash. I'm sure somebody here has used DoorDash, but this is their a picture of them in their Stanford Avenue apartment. I was, when we went to see them, they literally had, they were driving the cars at night. And as you know now, it's a $23 billion company, market cap, and over 6,000 employees. And perhaps the most interesting thing is they have over, 2 million drivers out on the road. Anyway, so that's about us. One thing, if you want to be any of those people in the 4 previous slides, then you should get involved with Pear. We have 2 programs for students. One is called Pear Competition, where we give up to 100K in an uncapped note, or else you can participate in our pre-seed funding program, which is called PearX, and it's basically up to 2 million in funding. So it's very easy to find us. I know you go to CMU, so you're very smart. So just go to our website. Okay, so with that, I will move to my talk. So the first thing is about what is a company. Not all companies should be venture-backed, right? And a question that you guys should have before you start raising money is, what type of company do you want to be? So there are really 3 types of companies. One is called a lifestyle company. So typically provides a service. The revenue doesn't grow. It's kind of like having a coffee shop or something like that. You could be a bootstrap company, which means you don't raise any money. So you use money that you get from your customers to fund the next growth, but you're interested still in growing the company. Because you don't have investment, you don't grow that fast. And finally, there's the venture-backed companies where they're very high growth, because you have investment, you have money to invest in them. Okay, so I'm going to give you 3 examples so you can see that it's actually not a bad idea to be the first type of 2 companies. Okay, this is a lifestyle company. It's called True Circuits. John Maniatis did his PhD with me. And when he finished his PhD, he started this company called True Circuits in 1998. Today, they have 5 employees. They've taken no money. And every year, they make in the order of $5 to $20 million. So he's making a lot of money every year, except, he didn't raise any money. He owns 100% of the company and has been pretty flat for a very long time, right? So anyways, that gives you a sense. This is another company. My partner, Arash, started it again in the same, right around when I was graduating. It's called Cariden, and it was a bootstrap company. They were actually selling network optimization software. And Cisco bought his company in 2012, 70 employees. He raised no money at all, and he sold it for $141 million. And this was 100% owned, there was by the employees, right? There was no money raised. So it's actually a pretty good deal if you are the founder of that company, right? Okay, this is the last one. It's venture-backed. My professor, Teresa Meng, started this company called Atheros. They were doing chipsets for telcos. Again, right as my time of graduation. And this company actually raised a lot of money, almost $100 million. They went IPO in 2004 for about $630 million, okay? Now they were bought by Qualcomm in 2011 for $3 billion. So the question is, which one is better economically for the founder? It's not super clear. And let me just give you the example. For True Circuits, these guys are making somewhere, maybe in a good year, they make 20, in a bad year, they make 5, but let's assume they make 10 million every year. That's a pretty good deal, right? That you're making. If you're Cariden, they had, I'm going to say the founders owned 80% and 20% was owned by employees. Still, 100 million to distribute over 11 years. So roughly the same. And how about Atheros? So Atheros, and I'm going to be very generous, assuming that at the end, the founders own 20%. And that may sound really low for you, but that's what happens in venture-backed companies. At the very end, the founders don't own much. The investors own most of the company. So they may have had $130 million at IPO, and maybe if they held to the stock for a few more years, it's a lot of years, 7 years, probably not, they would have been able to get a lot more money. Okay. So, depends on your spirit, what type of company you want to run. Let me tell you why. This is what revenue looks like for companies, venture-backed, because, it should go up fairly fast. If you're the right company, bootstrap is kind of linear and lifestyle is kind of flat. But there is a little secret, and is that venture-backed companies really look like this. You're losing revenue. You're not making money for several years, right? That's why you need venture money to back the company. So it's a very risky proposition. And only 10% of companies actually make it. 90% actually never make money and they die, right? So if you decide to go the venture route, it's a risky proposition for you guys. For us, it's okay because we have a portfolio of companies, so somebody will make it. But for you guys, it's a risky proposition. So the question is, what are your chances? So this is a picture of LeBron James when in high school, and actually today or yesterday. What are the chances of a high school player playing for the NBA? It's like 0.03%. So 3 in 10,000 of these high school seniors will actually play the NBA. It's a very small chance, right? Think of your high school. Did anybody go to the NBA? Probably not. So how about startups? This is data from 2012, okay? So in 2012, there were 600,000 companies roughly that got started. About, go back, sorry. About 4,000 raised a seed round, so $1 million, and about 1,000 raised a Series A. So 0.2% of companies raised a Series A. Yes, question?
Is it just in US or?
US. So this is twice as hard as playing for the NHL, which is, maybe hockey is very popular in Pittsburgh, but in California, where I normally show the slides, nobody really knows it. So people are like, oh, okay. But how about being a unicorn, right? There's only 22 unicorns that were founded in the year 2012, right? So your chances are 0.003%. That's 10 times harder than playing the NBA. So for you guys to know, everybody that is in this room starting this company, it's really hard to make it to a unicorn, a multi-billion-dollar company. It's really, really hard. So that's the bad news. There's some good news, though. And the good news is that it's pretty consistent. Every year, there's roughly about 20, more in the last few years, but it's going to get adjusted. About 20. It's like a physics constant. So you could be one of those 20, okay? And, we have many of them, I would say. So I wouldn't say there's an exact recipe, but at least there are some rules you can follow and some direction that increases your chances of actually hitting it. So we'll go with that. I think you may know some of this. How does VC work? We give you guys money. We get ownership in the company in the form of shares. When the risk goes down, so if you have customers or if you're growing, your valuation goes up, right? So at the beginning, the first money you raise is very, very expensive. You have to give a lot of your company for a little bit of money. But towards the end, when you're close to IPO, you couldn't raise hundreds of millions of dollars for a couple of percentage points. So this is one of our companies, DoorDash, just to give you a sense of how valuations or how venture capital works. They raised 120K to begin with, 2.4 million, 17, 40. Anyways, you can see even the numbers get higher very, very fast. But the equity that they give in that first 120K is much higher than perhaps what they gave in this, Series H at 400 million. So it's very important who you raise that money from. And this is the pre-money valuation, 2,854. It's pretty impressive. Okay. By the way, DoorDash was obviously a successful company, but this is an example of a not successful company. Does anybody know Quibi? What that is? No? One person. Well, that's good. They raised $1 billion before launching the product. Met Whitman, partner, some Hollywood people, and they believed the founder so much that they gave him $1 billion. And they were going to make this app that would show instead kind of Netflix shows, but in 6 minutes episodes, and you could watch them on your phone. And their big innovation is that when you would, move the phone, the frames would move. Anyways, it was kind of silly. No testing, nothing. So this company obviously died very quickly, like literally 3 months after launching the product, the company shut down. So raising money doesn't mean you're going to be successful, okay? It's no guarantee. So that's just one example, but many companies look like this. Okay, what should be my valuation? It really depends. Theoretically, a valuation should be the more traction I have, the more the valuation is. So it should follow some line. But what happens, especially at seed, is that a lot of other factors come into play. So if you are, say, an elite founder, so by being from CMU, you're already quite elite, you can command a higher valuation. If you're playing in a very hot market, so if anybody's doing generative AI today, then they could have a premium for whatever they're working on. But let's assume you're based in Ohio, you're going to be priced at a lower value. Okay. That's what happens at seed. But after the company gets bigger, these things kind of tend to, shorten, and none of it matters. Only your traction and revenue matter and your metrics. Nobody cares about other little things. So, it's when you guys go and raise your seed money or your pre-seed money, it's hard to compare yourself to exactly to your friend because there's a lot of variables that may matter as well. Okay. I have a lot of data. Allison has the slide, so you guys can look it up. But just to give you a sense, if you raise money, this is a table from, I think, from YC Series A's. Actually, no, this is actually from Cooley, from Wilson Sonsini, a law firm. But it says like what is roughly the valuation at every stage. Pre-seed is around 6 million, 10 million, 50, et cetera. And it changes every year. You guys can look at the links and follow whatever is the latest in the year. This chart is the one from YC. And just to give you a sense, they surveyed a bunch of companies and it's like, hey, what is your valuation? And the ranges of valuations are all over the place. So a Series A B2B company could be 15 to 75 million. It's like literally all over the place. Or, one of these consumer companies is from 15 to 107. It's like a 10x difference, right? So, you have to bear with the fact that investors don't always know how to price things. Okay. All right. So what drives valuation? Team, then traction, as I was saying. But there's one more thing that really, really matters, and that's market. If in order to be a venture-backed company, you have to have a big market. And if you don't have a big market, then you're better off being a lifestyle business or a bootstrap business. So it's perhaps when you make that decision, or should I raise money? First, answer the question, am I playing in a big market or in a small market? And you should be honest with yourself because there's ways to make money in the other way. Okay. All right. Okay. So this is what a startup looks like at the beginning. And many of you may be in what I call the drunken walk. You really, one day you feel like you're going IPO and the next day you feel like you're shutting down the company and you need to change what you're working on. That's how it feels. People are stumbling around. But eventually if people make it, they grow. And at the beginning, we call it zero pre-seed or pre-seed. Once you have something that somebody really, really likes, we call it 0.5, so product love. And once you figure out how to sell it, we call it product market fit, okay? And the things, I'm gonna talk about these 4 things, but basically the things that people look for at these stages are the following. At the beginning is market and team. And later, they will look for some traction. So if you're trying to raise a seed, people will want to know what is, again, do customers like you and can you grow? Okay. So let's start with team. This is my number 1 question when I go give a talk. How do you choose founders? What makes a good team? My partner always says that describing a good founder is like describing a good wine. You can't really put it into words, but once you've tasted a good wine, you know what's a good wine. So it's almost the same. I also tell people, describe what's a good spouse for you. It's actually pretty hard, but there's probably something that suits you, right? There's really no exact formula. And the good news is there's a lot of venture people. So I like a certain kind of founders, but other venture people like other kind of founders. So you can think of it as art. These 2 pieces have similar prices, but I bet you the same people don't like the same paintings, right? So it's the same idea. There's just different tastes on people. Just a couple of things that matter for you guys is that when we meet founders, it's not once, we meet them once. Sometimes we meet them several times. There's this really great blog post by Mark Sisters that founders are lines, not dots, meaning you're not evaluated just the first time I meet you. You're evaluated all the subsequent times I meet you. And if I see that you're making progress or you're getting better, then you have a much higher chance of raising money, right? So it's really important. If you meet somebody and they're like, hey, we're not ready to fund you, you can keep them updated. You can tell them I've made progress. Those 2, second, and third, and fourth meetings matter a lot. and because you're forming your opinion about a person. So that's important. So anyways, you can read the blog post. The last thing I said is that, you know, I have a picture there of like what the founder journey is. It's such an emotional journey to be a founder that you are really looking for almost people that don't give up, people that are super focused, people that can listen. There's just all these qualities, but just imagine sending somebody in this very difficult journey, right? You want those qualities in that founder. Anyways, I will leave you with that. Let's talk about market. I think this is maybe the most important part because I find many people don't know how to size markets. And that's what all that venture is about. It's about sizing markets. So big companies need big markets. This is Andy Ratcliffe. He was one of the, he used to be a partner at Benchmark, and now he founded Wealthfront. And he has this, I'll read it because he's famous for these sentences. When a great team meets a lousy market, the market wins. So if you're playing in a bad market, the company's not going to work. It's not going to be an IPO. When a lousy team meets a great market, the market wins. So when you're riding a wave, remember the .com or whatnot, if the market is pulling you, even if your team is not great, you can still make it. But when a great team meets a great market, then something magical happens, right? So in our job, my job is only to find great people and understand that they're playing in a big market. And then, you know, some of them will work with a high degree of chance. So you should feel the same way when you're recruiting that co-founder that you're looking for. You know, you have to really aim for somebody great, not the first person that comes through the door, because it determines your chances of success. Okay, so how do you size a market? If you go to business school, they will, or, you know, read things around, people like top-down market sizing. This is absolutely the wrong way to do it. So if you raise money with this, you're gonna go, it's not, I mean, we're gonna throw you out the door. So this is what the top-down would say. This is, Imagine is a company doing AI for oncology. They would come to me and say, hey, the healthcare AI market from some McKinsey report is 500 billion. First, I have to believe McKinsey. And I'm going to take 2% of it. So my TAM is 10 billion. Okay. That's the way they would, that's the top down analysis. The bottoms up is the true sizing, which is how many customers times the average revenue per customer. And that gives you a sense of the size of the market. So they would tell me, hey, there's 2,000 US hospitals. I think I can do 50K scans per hospital per year and charge $100. And if you do the math, this will come to 10 billion in TAM. And that's like 10 times more believable than the previous one, at least to me. I hope to you as well. So sizing the market is like the simplest math possible. How many customers, how much revenue per year per customer? It's super easy. Again, there's a great blog post by Sequoia explaining this very simple equation, but there's companies in this curve, you know, this customers times revenue per customer. And you can be Facebook, where you can make $10 per user and have 2 billion, almost 3 billion users. Or you can be somebody like Zoom that has maybe 370,000 customers and this makes $7,000 per customer. When you do your business, you have to figure out where in the curve you're going to be, where in the curve. And then based on where you are in the curve, you can figure out, okay, how do I acquire those customers with, you know, and not lose money acquiring them? Okay. So this looks very simple, but I promise you it's the hardest thing to do as a founder. So go read that. There's another important thing. You may start with a small product, and your small product may say it's product A that you're going to sell to 100K customers. It's just $1 billion market. You can say, hey, I'm going to start with this product. And once I have this product, let's assume I'm going to start with a Word editor, okay, text editor. And now 5 years from now, I'm planning to release a spreadsheet document, spreadsheet, whatever tool, or maybe notes or whatnot. And I'm going to be able to charge a lot more to a lot more people. So you can tell that story when you're fundraising. I'm going to start in a wedge market and then go bigger. It has to be closer. It can't be like I start here and I go there. So there has to be a threat and a story, but this is something you can do. Okay. How big is big enough? Get that question a lot. So for our business, we need companies that are anywhere from $3 to $10 billion in market. And that means 100 to 500 million in revenue per year. 100 to 500 million per year in revenue. It's a lot of money, as you can imagine. But, you know, all successful companies that go IPO actually hit that $100 million fairly quickly. So let me give you a couple of examples that you're very familiar with. This is Google. This is Google's revenue from when they were founded in 1999 until a year ago. And this is, yes, almost like $300 billion. It's like a huge number. Most people think, oh, Google, when they launched it, it was free, they made no money, and eventually it turned ads on and it worked. But this is the revenue of Google the first 4 years that they were around. Can you imagine being for 4 years and you're making $350 million in your 4th year of life? That's a really good company, right? That's why they're such a big company. This is Facebook, same thing. You know, they had a bad year. So in 2022, that's why their stock is down. But look at this, the scale is 125 billion. And again, you would think Mark Zuckerberg was making no money, but you know, they got to $150 million in 4 years. That's a big deal. So Facebook was actually making money year one, right? And it's, you know, same with DoorDash, same with Garden. Anybody that goes public really has to be in this high growth trajectory. And that's where venture really helps. Okay, I'm going to skip some of this, but I will say that at the beginning, when you're now fundraising and you are estimating the market, so you say, I think I can sell it to this many people, and I think I can charge this much. But when you are getting farther in the history of the company, those numbers stop being estimates and they really become actual numbers. So estimating, you have to be really get good at estimating. Okay, I'm going to skip this and go to traction. I don't know if you guys have any questions on market. No? Okay, let's go to traction, which is proof that you can execute. All right, so there's 3 stages. At pre-seed, the only thing we look for is some initial validation, and it's important to have some initial validation. At seed, we look for a few customers that pay, a few customers that love your product. They don't necessarily have to pay, but it's good if they pay. And at Series A, people are looking for a repeatable and scalable growth engine. Okay, so let's start with pre-seed. What, if you want to raise pre-seed from Pear, what would you have to look like? Okay, let's assume, you know, your pre-seed round, so somewhere between 100K and $1.5 million. Who's interested in raising pre-seed money? 2 people, 3 people, 4 people. Okay, well, this is for the 4 people and whoever is on the Zoom. So you have no product, I'm assuming, and you have no customers. So it's just you. How do you go and raise money if it's just you? You have to tell a good story, right? So it's really important to be a good storyteller. There's a lot of, this is kind of the hero's journey where there's like this rising action and climax, and then you go and save the world. If you have time at CMU, go take a public speaking class or a storytelling class. It's super useful if you're a founder. Whether you're raising money or you're selling your product, is one of the most useful things you could do. The second thing is you generate FOMO. So because there's nothing to show, you have to make it feel to investors that if they don't invest in you, they're missing out on something really, really important. And a lot of investors are motivated by FOMO. So, you know, you can use sentences like, this company is inevitable, you know, like the world is changing and this company should exist, right? Or there's a major tech disruption going on, e.g., whatever is the flavor of the day. This will mean that all software needs to be reinvented and my company should exist. So it's important that you put it to the investor in terms that motivate them to invest in you. I teach a class at Stanford called the Lean Launchpad, and the whole purpose of the class is to help people validate their ideas. That's all we do. And we call it get out of the building, which means talk to customers. I'm going to give you 3 examples of, you know, I've been doing this for many years, 7 years. Each year we have about 8 teams. So, you know, you can do the math, but we've done about 60 companies. But I'm going to give you 3 examples of what people do so that can spark your imagination. This is one of our companies called Aussie. They've raised a bunch of money, but they have screens on top of Ubers and taxis to do advertising. So it's geo-targeted advertising. So how did they validate that somebody cared about that? So they wanted to see if drivers would be willing to run ads in their car for $10 a day, okay? So what they do, they reached out to a bunch of Uber drivers, and then they said, hey, if we get some success, a third of them say yes, we're gonna move forward. So they actually would reach out to drivers, and you can see what people would say. Hi, Condescending is the founder. This is Uber driver. When do you think that I can get advertising to put on my car? I have 2 cars. That means somebody really wants his product, right? And somebody saying, please reply. That's a customer that really wants that product. So, and just to give you an, they wanted to put these digital displays, but their MVP was really like a banner in the car, right? And that's what pre-seed is. You don't have to have a full product. You don't have to have a team of 5 or 10 people, building the ultimate software. It's more like test that somebody actually wants that product in the minimum way possible. So that's one example. I'll give you another example. This is a company called Bozy. They wanted to build kind of like an AI assistant for the house. So they wanted to see if moms would pay for having an assistant where they could text them things to do and the mom would respond. So they were actually all business school students. So they had no engineers. They couldn't code anything. So they did what we call the Wizard of Oz. So each of the 5 team members partnered with a mom, and the mom would text them. And instead of going to a software, it would go to a human, one of the team members, and the team member would actually respond for them, right? So, the text would be like this: remind me to text Sam about meeting or whatever. It's Tuesday, I have it. They would shop for things on Amazon, whatever it was. And actually they got a lot of customer information out of this, right? And they had great results, 27 moms interviewed, 5 signups. That's a very high conversion rate. And actually they didn't continue because they didn't have engineers, but I'm thinking, the demand was there. So if somebody uses ChatGPT today, probably they could help the moms put this together. It might be a useful product. Anyways, this is the last one, which I show because I think it's really interesting for all of you guys. This is a team that we had that was also trying to connect moms to community, and they didn't really have a good idea. So they decided, hey, we don't really know which way to go. We're going to put 3 landing pages, send a bunch of Facebook ads, and then whichever converts the best, we think we're going to go and choose this one. Okay. So they had 3 ideas. One is renting gear for when you go on a trip, baby gear, when you go with your parent and you don't want to pack everything, so you would rent it. Another one was kind of like a WeWork for moms. So you could drop your kids in one room and you could go have fun in the other room. And the other one was like a telemom. So kind of ask, I think you mentioned postpartum, but mentioning kind of postpartum questions and so on. Anyways, and then they run a bunch of ads they actually had the original idea and 3 new ones. And this says, hey, how many people clicked on the ad and how many people actually gave us their email, right? So when you go to the website, there was a call to action, give me your email. And this gives you an indication, of what people were interested on. I believe font was the WeWork type thing. I can't remember, but, which is not good because people just want to dump their kids in some room and then go do something else. But it's an easy way for you to test marketing messages, ideas. And, we have a couple of classes just on how to do this, but it's not hard to find online. Okay. So that's all you need to do to raise up to roughly $1.5 million, right? Show that there's some validation. You don't need a big team. You don't need, a finished product. You just need to show some execution and have some comprehension of market. Okay. Now assume you want to raise a seed. What is a seed? It's something between $2 million and $4 million. So I think that's a little bigger, right? And that requires a little more than just those, real MVPs. So what does that mean? Okay. I say love, not scale. So this is all about love. If you remember one word, love is what you should remember. It's to reach 1 million users. You start with a product that a few people love, not that many people like. So you need a few people to be really, really obsessed with that product. Okay. Why? Because when people are obsessed about something, they tell other people. So that allows you to grow very efficiently. So let me give you some examples of love. This is Google. I was a grad student. This happened. I'm sure it's happened to you. And I was using some other search engine at the time, Alta Vista. There were a lot of search engines at the time. But I remember trying Google. And the first time I tried Google, I was like, oh my gosh, I'm never using any other search engine again. And this is kind of what their server, their first data center looked like. It was at the basement of the computer science building. And every night the lights would go off because it was so busy. And they had obviously, I don't know, some crappy computers. You probably have felt this way about some product. You know, I think you're too young to have seen the first iPhone. But some people, when they got their first iPhone, felt that way. Or when they got their first Tesla, they're like, I'm never driving anything again because this product is so good, right? There are some of those people running around. So that's one kind of love that if you can achieve it, it's a big indication that you're in the right track. Okay. Another indication is when, you know, the kind of customers can't get enough. The phone is ringing off the hook. This is the first page of DoorDash. It was called Palo Alto Delivery. This is their website. You literally would call the CEO's phone number to place an order, and you would click on any of these things, which was restaurants in Palo Alto, and it would pop out a PDF. They had no software. You literally would call him and say, I want this and this and this. They would write it down, pick it up, and deliver it. And they couldn't keep up, even though the product was just really very, very basic, right? But that's a clear sense when you can't keep up with your demand. It's a sign that you're, you know, in the right way. Another way, I call it love declarations. Does anybody know what is Superhuman? One person. Okay, Superhuman is this email client that people love. At least in my office, everybody uses Superhuman. It's an amazing email client. And people post, I took this post from Twitter, but this tool saved my marriage. I shall sacrifice my firstborn child for the cause. So when people talk like that about a product, and people do sometimes talk like that about products, it's a sign that they love you, okay? There's other qualitative signs. You know, you're recommending products to other people. You as a founder don't have to do anything. You don't have to change the product. People still like you, and people come and see you. There's many qualitative signs. Okay, this is important because I think you guys will want to eventually raise a seed round. And I call love when you have 1,000 users, and after 90 days, you still have 600 of them. That's called 60% retention. That's love. Like is when you have 10,000 users, so many more, right? But only 20% are there after 90 days. And typically a founder will come and say, I have 10,000 users. I'm doing so great. I'm growing. But if you're not keeping your users, if you don't have people that love you, then you're not a good company, right? So if you're a B2B company, sometimes people come to me and say, I have 10 POCs. So 10 POCs are, you know, proofs of concept. That's customers that say, hey, I'll try your product. Sure, I'll try your product. That's great. Maybe there is some demand, but I'm not looking for demand. That was for my pre-seed. For seed, I'm looking for that somebody really like your product. So I want to see one POC that is converted at least. And I want to see that that is converting into a contract, or they're paying you, they're expanding the usage in the company. And then I want to see there's more in the pipeline that look like that. So it's not about quantity, it's about the quality at the seed stage. That's actually really important to remember. Okay. All right. Last one, which is Series A. So Series A is a big round. I know it may feel far away for some of the people here, but it's not that far away for some companies. You can raise anywhere from $6 million to $20 million in a Series A. That's a lot of money. And what do people use this money for is to scale the business. So in order to raise Series A, there's a lot of myths out on the street about how much, where should you be, right? Most people say, oh, if I hit $1 million in ARR is annualized revenue rate. So, but roughly, so if I reach $1 million, I'm ready for Series A. That is not true. Many companies reach $1 million and cannot raise Series A. And you'll be like, why? What's the problem? So there's a lot of myths. This is the next few slides will demystify that. first, let me show you this proof that I'm telling the truth. This is a graph that shows valuation on the x-axis and on the y-axis monthly revenue, okay? It should be in thousands of dollars, but anyways, you can see that actually it really doesn't matter what your revenue is to figure out what your valuation is. It's almost like a flat line. And you're like, why? Why is it a flat line? Are all VCs crazy, right? Why? Well, this is why. Two companies could come in. Company A has a higher revenue than company B, okay? It's not about the value, it's about the slope. So we're really trying to figure out which company has a higher chance of having a big revenue the next year and 10 years from now. So it's the slope that matters, not the actual revenue at a given time. And how do we figure out what the slope is? How can we predict slope? There's a lot of variables I will show you now, but there's some numbers that VCs ask of founders that help us predict which company will do well and which company will not do well, okay? All right. What is enough? There's two things that we look for. One is the customers that stick around. So customers that don't leave, similar to seed. We want customers that just stick with you. And the second is we need an efficient, repeatable growth loop. What does it mean, efficient and repeatable? Efficient means that I not only know how to get one customer, I know how to get 10, how to get 100, and I know how to do it in a way where I make money. So if a customer is paying me $100, I can get them for less than 50, right? And then I at least make a profit. It's if you can get a customer for $200 and the customer just pays you 100, then you don't have an efficient growth engine. Many companies have that problem, believe it or not, especially if they have venture money. And what is repeatable? Repeatable means that it doesn't depend on Peter, who's your best sales guy, for example. It's something that you can actually train salespeople to do, or or you can scalable. You have paid advertising, you can do it that way, etc. Okay. All right. So let's go to number one. How do we measure? What things you should measure to figure number one? First, this is the most important, retention. Like I was mentioning earlier in the example, this would be the number of customers that returns over time. When the company has product market fit, it becomes flat at some point. When the company doesn't have product market fit, it keeps going down and down and down all the way to zero. Okay, so retention, if you can memorize one thing, measure retention. Okay. The second is the Superhuman survey. It's a quantitative test of product market fit. There's a blog post you can read, but basically the way it works is you have at least 100 customers. So you need enough customers. If you have B2B, you can go to 10. It's okay. And you say, hey, how would you feel if you could no longer use my product? And you say, very disappointed, somewhat disappointed, not disappointed, or I no longer use the product. And he says, well, if you get 40% very disappointed, you have product market fit. This is not scientific, so nobody did research on this. This is just his number. So it could be 35, it could be 50, it doesn't matter. But a good chunk of your people would really need your product. And many folks that raise money use this test when they go raise money to say, I have product market fit. I'll skip this slide. It's more on that. If you're a B2B company, I don't know how many are, there's a number that we use called we, meaning the venture community, and you can read about it in the blog post, but it's called quick ratio. So it means there's the ratio of how much revenue you add in 1 quarter or 1 month and how much do you lose, right? So theoretically, you should be adding a lot more revenue than you should lose. So for example, this portfolio company 2, for example, it's adding a lot more revenue than it's losing, but maybe company A that was pitching to them, maybe they're still growing, but look at how much revenue they're losing every month. It's probably not a great company, right? So you have to double tap on that growth and figure out the quality of that growth. Okay. This may be interesting for you. If you look at the App Store and you look at all the apps out there, the top 10 actually have roughly 60% retention after 90 days. The other ones, the next 50, the next 100, next 5,000 have this look. So if you build an app and that app has at least 60% retention, you're likely going to be in the top 10. That's a big deal, right? It doesn't really quite work that way, but think of any app that you use every day. That's probably a pretty famous app, right? Anyways. Okay. This curve may look really complicated, but I have it. If maybe I think at least we have one business school student, they probably know this curve, but this is called the cohort analysis. I don't have a blog post for this, but if you type on Google cohort analysis, there's a ton of literature on that. And it's how do you measure the health of your company? Lots of numbers, but basically you track, this reads like the first row reads in January, I gained 110 customers. On February, 33% of them were around, 21% in March, 16 in April, et cetera, et cetera. So it gives you a sense of how you're improving on a month-to-month basis. And if you run a company, you need this as a CEO to guide your decisions. Okay. Efficient growth engine. What is an efficient, what does that mean? So will I grow fast without spending a lot of money? So, okay. There's two numbers. Have you heard of these numbers, CAC and LTV? Nobody? Okay. These are the two most important numbers you should know for determining growth. CAC is customer acquisition cost, and LTV is the long-term value of a customer, okay? So customer acquisition cost is how much money do you have to spend in marketing or sales to acquire a customer. So let's assume you spend $10,000 a month in running Facebook ad and you acquired 500 users, then your CAC is 10,000 divided by 500, $20. So it costs you $20 to acquire a customer, right? If you're running a company, your goal is to get that number as low as possible, right? In fact, you would like it to be zero. You would like it to not pay anything. You just would like word of mouth to work, other people to tell other people about your product. You're going to test all the channels, Facebook, Google, LinkedIn, whatever you can to get that number to as low as possible. But that's your job as a founder. Okay, what is LTV? This is, I guess it's some music app, I don't know. Let's assume you have a music app. A user pays $10 per month and you make 50% margin. So you pay $5 to Sony and you keep $5, okay? And a customer on average stays with you for 10 months, okay? I guess I didn't do the margin, so forget the margin, but I assume 100% margin in this equation. But if you do this, then how much money are you gonna get of a customer? $10 times 50%, oh, I did it, times 50% times 10, so just $50, okay? So you're gonna make $50 from a customer, and it takes you $20 to get it. That's a good business, right? Let's assume your customer only stayed with you for 2 months. Then it wouldn't be a good business. You would need your CAC to be much, much lower, right? So it's important to get this equation right. There's a magic number in venture. LTV over CAC has to be bigger than 3. This is, again, not scientific. It's some conventional wisdom that people have around. Why 3? Is because if you need to make money out of a customer, at least more than what it costs you, so you can pay for other things like the office building, you know, SG&A and, you know, engineering, et cetera, et cetera. So this number has to be, can't just be 1. Okay. If you're, since it is the first time you hear about CAC and LTV, let me tell you what it, give you a picture. When you run the ad and you spend your $20, you're in the red because you spend $20 getting that person, right? But after 2 months, they're going to pay you back, I guess, you know, or 4 months with the margin. They're going to pay you back. Then you start getting green and you start making money out of the account. So that's a way in your brain. I find it very useful to, you know, visualize what does it mean, an efficient growth engine. This is what it means. And you want the green area to be as big as possible, right? And the red area to be as small as possible. And these 2 numbers here, CAC payback and churn, are very important. Payback is how long does it take you to recuperate your money, right? So it could take you 1 month, basically this, in a month, you get your $20 back. It could take you a year, right? Same with churn. You could churn after 2 months or you could churn after 2 years or whatnot. So those are 2 important metrics. I have them described here, churn and payback. You guys can read it later. But one important thing to know is that in venture, if you don't recuperate your money, your CAC, in less than 12 months, you can't get funded because then you can't grow fast. You know, you need to raise a lot of money to keep growing. So it's important to recuperate it within 12 months. Okay. All right. Other tests for reaching Series A. When you're scalable means that you can repeat what you're doing. So if you hire one new salesperson, you know that you're going to be closing a certain amount of business from that person. If you spend 10,000 in ads more, you know how many new users you're going to get. So you can predict how your dollars are going to translate into customers. That's what it means. I have a lot of slides that I will just leave for you guys. They're just a bunch of numbers, and maybe too early for you guys now, since you're still going to have to raise pre-seed. But it tells you, like, people like us, venture people, what are the metrics that we're looking at when you come to us to raise Series A? So lots of numbers. I'm not going to cover them. You have them for yourself. I'll just finish up with a couple of slides. Remember that high growth is really important. So you're in a business that is not growing fast. Something is not working, okay? So this is typically good businesses, how they work. You want to reach around $100 million in 8 years. That's like not the exceptional built businesses, but the good businesses. So in years 1 or 3, you want to get to 2 million, then triple, double, double. That's another kind of venture rule that we follow. And when companies are in this trajectory, they're considered best in class. When they grow at lower rates, they're not considered best in class. So the valuations are much lower. So just remember, triple, double. And I'll just skip that. But just to give you a sense, it's incredible. But these are all public companies: UiPath, Slack, HashiCorp, many. They're all SaaS companies. But this is the years it took them to go from 1 million to 100 million in ARR. So for UiPath, it was like a year and a half, right? It's very impressive. They're like a tear. That's why their valuation, is like 34x the revenue, because they're growing so fast. So it's the same with a startup. When you're growing that fast, you will, you'll get compensated in a high valuation. All right, summary. This is the rule you should remember: nail it, then scale it. So nail it means first get something that people like. I tell the story, like, imagine you want to invent Coke. The first thing you would do is go in your home kitchen and try to come up with some formula and iterate 50 times until you get people that really like whatever drink you're making. It can't be your mom or your roommate. It has to be somebody you don't know that likes that product, right? Especially for consumer products, because we are very, people don't like to tell you your product is not good. And once you figure out your product is good, then you go build the factories, okay, to scale that product. But don't spend money on marketing and on sales until you have a product that people really like. And my last slide, I surveyed a bunch of VCs. What are the most important metrics when evaluating a startup's potential scale? And you can see that seed investors, which is what I am, versus growth investors, we care about different things. I'm not worried about profit when I back a company, because I know we're in that green curve. All my companies lose money. I'd say one company that doesn't lose money, but all my companies, when they're in seed, lose money. I don't quite worry about valuation multiple, because I get in so early that I'm always going to make money in the big companies. But you're a growth investor, your entry point may be $1 billion. You really care about that. However, we all care about size of market and what is your revenue and your revenue growth. So that's what's important for you guys to keep in mind. And of course, team, as I mentioned at the very beginning. Okay, so with that, I think I have like maybe 3 minutes for questions, or 4 minutes. So I'll leave it there. If there are questions, I don't know.
I have a question about the Wizard of Oz strategy that you talked about. I know DoorDash did that, and the other companies.
Ozzy.
Yeah. What do you see in the success of that strategy? And is it a great way to find customer love? And then
it's a great way. Like, if you don't have any money, you don't have any engineers, if you don't have any time, it's a great way to test if people actually like your product. You can only serve a few customers because you're literally manually doing the work, right? But it's a great way to see if you have demand, for sure. And you can always put people on a wait list. So let's assume, people really wanted to have that mom concierge. You can be like, thank you, put your name here. As soon as we have somebody, we'll send you back. And it's a great way of collecting a list of customers, but very useful. Not scalable, but useful at the very beginning.
As a pre-seed investor, how involved are you in like touching base, meeting, advising?
Very involved. It depends on the founders, but very involved. When the company is in crisis and there's multiple crises that happen, when you're pre-seed, you may not be able to hire somebody, you may lose a customer, you may go through a pivot, you may have a hard time fundraising, you may see you every day or several times a day. But if things are going well, then I don't need to see you all the time, right? Or if you're an experienced founder. So it really depends on the founder and what's going on at the company at the time.
Do you have any advice for if you're like a really early stage startup, but you're looking to do B2B, how to get that first customer? Because I know like when you use like the DoorDash example where it's like you have consumers and it's small purchases, it's not necessarily a big commitment to order food from a restaurant, and it's a little easier to gauge interest.
Yes.
Like, but what about if you're trying to sell to like bigger companies?
Yes, that's and we have a lot of B2B companies in my class. So the amazing thing about where we are today is that you can use LinkedIn and reach out to anybody basically very easily. So my advice to you, because you're a CMU student, you would say, hi, I'm a CMU student. I'm working on this project and I'd love to get 50 minutes of your time to talk to you about X. Okay. And it's important. What I would recommend to you is reach out first to people that are in your network or at least CMU alums, because those will have a higher chance of responding to you. And make sure you say, I'm a CMU student. That has a high conversion rate. LinkedIn works really, really, really well. I promise it's incredible. My companies, my students they're experts at writing those LinkedIn messages and optimizing what they say. I've taught my other child to be also a master of LinkedIn, and he found his summer internship using LinkedIn and data using LinkedIn. Just it's an amazing tool. And the only thing you have to be aware is that the numbers are very low. So you may send 100 emails and get 2 responses. So you may be depressed, but what I say, it's just a numbers game. If it takes you 100 to get 2, well, if you want to get 10, you know what to do. You have to write 500, right? So that's what I would tell you. Yeah. And use your network here. Use your network.
Do you miss being an operator?
I am an operator. Pear is my company. So yes, I am not just an investor. I'm building Pear. So we started as 2 people. We're 23 people now. So I feel like we're building a company slow, but still a company. Yes. Our fund 4 is $400 million. So it's one of the largest seed funds in the US. So, very proud of that.
What do you see as like the biggest mistake people make when they're trying to get it?
The biggest mistake, there's so many. So, but, when they're raising pre-seed, the biggest mistake is to not have spent enough time with customers. So when I ask questions about what's your insight, why does this product make sense, they don't know how to answer it, right? So I like people that are what I call customer savants. So they really, really know their customer, right? In the best case, you're solving a problem for yourself. You're the customer, right? If not, maybe you work in a business or very close to somebody that had that problem. But if not, you've spent a lot of time interviewing people that have that problem. I look for that. And when there's I call it founder customer fit, when there's no fit there, it's a red flag for me. The personal characteristics of founders, the worst is when people are too confident, and that typically goes with ego. But if you're too confident, you're going to fail because you need to be a little paranoid about all the things that are coming to you. And some people have a big ego. It happens less with women, so that's a good thing. Oh, chat. Oh, it's a long question. I don't know if it's a question. No, it's not. Comments.
Any other questions? Okay. Well,
Thank you so much. Thank you, guys.